Joining me is Scheherezade Rehman, Professor of International Business at George Washington University. First of all, welcome, Professor. Good to see you. We have so many questions for you. First, you just came back from Turkey, by the way, and I have to ask you about your experience there with the riots and with the tear gas and everything. How was it?
Well, no one likes to get tear gassed, but we got caught on the very first day of riots. We had a group of 30 students assessing global risk in emerging markets, and we were on Taskim Square when the first tear gas canisters exploded. So we saw firsthand what volatility can emerge from emerging markets, because the previous morning we were at the largest bank being wowed by the technology that they had for cybersecurity.
That is one heck of a field trip for the kids, and of course for the professor as well. So you talk about the emerging markets, and we were just talking about that. You know, the carry trade. People borrow against the dollar, they take that money and they place bets in other countries, preferably countries that are growing very fast, which happen to be emerging markets over the past couple of years. Do you think it's about unwinding those positions for a lot of investors, or is there something else going on in the world that maybe we're not seeing?
The carry trade is almost an effect that happens after the fact that you're growing fast. You have to grow fast to be able to pull that off. And what we've been seeing is a slow withdrawal of, an orderly withdrawal of money coming out of emerging markets. What you saw yesterday was a pretty sharp downturn in a lot of emerging markets across the board, and that's what scared us. But this orderly withdrawal of funds has been happening for some time, partly because the U.S. is growing again, partly because U.S. assets are looking better again, and there's a natural progression for emerging markets to slow down.
I have a theory that I want to run by you. You can tell me if I'm wrong. But over the past couple of years, the United States wasn't growing all that fast, and Europe obviously had its own problems, so a lot of money went into emerging markets because that was where they felt safest. But as Europe has sort of slowly come back and America has slowly come back, a lot of that money that went to those risky places are starting to maybe trickle back. Is that possible?
Well, that's definitely part of the equation. The only correction I would make there is I don't think Europe is really coming back just yet. Europe is staying the same. They are fuddling through their crises, but there's no real economic plan to grow fast. But in the United States, you know, growth is coming. You know, it's not as fast as we would like it, but it's better than expected. And I think people are seeing safer assets now.
This discussion of this, some people call it tapering, some people call it the inverse of stimulus. I mean, there's all sorts of, basically, the Federal Reserve has pumped a lot of money into the system. The question is how do we take that money and kind of take it back out?
Well, you know, the markets are still jittery, and as you alluded before, that they might stop QE3, which is $85 billion a month stimulus. But very quickly, the Federal Reserve said, well, they're not going to do anything right now. But we know that all the central banks in the rich countries are going to taper off the stimulus at some point, and it's happening across the board. The ECB has to be more careful because they're being almost sued by Germany to stop their involvement in bond buying. Bank of Japan has kind of indicated they're not going to do it anytime soon. Bank of England has a new governor who's not jumping up and down and saying a QE.
The World Bank, as I mentioned earlier, cut its forecast for China. Not a huge reaction either way. I mean, does it matter whether China's growing at 7% or 8%, or is the structural reforms more important to China rather than the individual GDP figure?
Well, I think, of course, it matters if they're going 8% or 6.2%. It matters to other countries like Brazil, for example. It matters to Australia because they are the ones who are exporting raw materials to China. For China itself, all the emerging markets took a pretty big hit yesterday. China's the only one that's relatively safe because money withdrawal from the emerging markets means slow growth and higher interest rates for them. But China is the only emerging market out there that does not really truly rely on foreign investment pouring in for its growth. It's got enough of money inside now to generate domestic demand.
They are a very big fish in a very big ocean. Scheherezade Rehman, thank you very much, Professor at George Washington University. Thank you and welcome back, and it's good to see that you're safe.